Hello, Jenny Kassan here. I'm really excited to do my weekly video for you all today. And as usual, I'm going to be laying down the law about strategies you can use to get your business funded successfully and do it on your own terms. So just as some background, I am a lawyer and I've been helping entrepreneurs raise money for almost 15 years. I've also raised money for my own businesses. And what I really specialize in is customizing your capital raising strategy to fit your particular situation. So, and what you'll find if you kind of are looking around for advice on how to raise money, legal advice or just any kind of advice, my guess is that most of what you'll find is actually pretty cookie cutter. It kind of assumes certain things about how you're going to be raising money, what type of business you have, and sometimes they don't even make those assumptions explicit. So my mission is to really help everyone understand all the different options and choices so that you can make an informed decision and not just go down a path because you're not even told that there are other options. So that's kind of what I wanted to talk about today. First of all, I just wanted to mention that last time we talked about a cash calendaring system that you can use to get money into your business quickly from investors, get your capital raising done quickly. So if you want to learn about that, definitely check out last week's video. But yeah, let's dive into a kind of a big decision that you really do need to make when you're raising money that many of your advisors and other sources of information, your lawyer, may not even tell you that this is a decision you need to make. And they might kind of just make it for you because they don't even really realize that it's a decision, that there's choices and that they're putting you down a certain path. So I was talking to a client, a potential client the other day, and I was asking, as I ask so many entrepreneurs, what are your goals for your business? What do you want to happen in your business? How do you want your life to be? And here's some important questions to answer for yourself. Do you want to stay in control of your business over the long term, or is it okay with you to give up control in order to get investment and to grow your business? Sorry, looking at my notes. So number 2, is your goal to just grow your business really, really fast at all costs so that you can sell the company at a high price to a larger corporation as quickly as possible? So basically, you're looking to just dominate a market as quickly as possible, and you're totally focused on growth, even if that focus actually kind of prevents you from maybe being true to all your values, because your number one goal is growth and selling the company within 5 to 7 years to a larger company that will acquire your company for at least 10 plus times the current value of your company. And do you want to work really, really hard to push for that growth with your investors kind of breathing down your neck to make sure that you are meeting those growth goals that they've set for you, because that's how they want you to, that's what they want, because that's how they're going to get paid, is if you sell your company in 5 to 7 years. And let's see, what else do I want to ask you? Also, do you want to you kind of you have to decide, like, do you want a profitable company where, within a few years your company starts to make a profit and becomes sustainable financially, where the money you're making in your business is covering your costs and is allowing you to fuel a healthy growth of your business? Or would you rather have a company where profit isn't really what you're looking for. What you really are focusing on is growth, and you're willing to go very, very deep into a hole financially to fund that growth, which means you have to be raising money all the time, basically. Like you're raising multiple rounds of financing to finance that growth, and you're kind of throwing as much money as possible at marketing and things like that to be able to grow the company. So now, you might know I'm a little, based on the way I'm talking, you might know that I'm a little biased. I don't think that business model is necessarily a super healthy or desirable one for many, many people, for me included. However, I know there are people out there who do want that for their business. And if you do, then you should definitely raise money in the way that your lawyer and your advisor are probably telling you to, which I call the venture capital path. Now, that can be confusing because some people are like, well, I'm not going for a venture capitalist. I'm going for angel investors, or I'm going for impact investors. But you need to be aware that the venture capital path is made up of more than just venture capitalists. It's made up of a whole ecosystem, including most angel investors that are like active angel investors. So even if you're not currently raising money from venture capitalists, if you're raising money from active angels, or you're going into an accelerator program, or you're going into all different kinds of potential sources of funding that are maybe called impact investors, things like that, I would guess about 95% of those are in the venture capital model. They're all, those investors are all part of an ecosystem where what they're expecting you to do is to grow your company as fast as possible so that it can be sold at a high valuation within 5 to 7 years. So that is a way of raising money that's going to put you on the path to doing all those things I was talking about before. And again, that's fine, but if you don't want those things for your company, don't go down that path. I see way too many. So I was talking to a potential client the other day, and he was saying, I just really don't want to go down the venture capital path. I don't want to give up control. I'm really mission driven. I want to stay true to my mission and values. I want the company to be, a healthy, sustainable company that becomes profitable. And I'm pitching to all these angel investors. And I was like, why are you doing that? And guess what? Like, some of the people he's pitching to are like, not that thrilled with what he's saying. They're like, really? Are you that committed to the mission? Because, it's just not a good fit. So I kind of I had an image in my mind of someone standing on there's like a crack in the earth, and you have one foot on either side, and the crack is widening and widening and widening, and you need to pick a side. Don't try to keep a foot in each side. Don't say like, yeah, I don't really want to go down the venture capital path, but I'm going to spend all my time pitching to investors that are part of the venture capital ecosystem. So make a decision, yes or no. Do you want the venture capital path with all that's entailed in it, or no? If you don't, then just don't even go into that world. Don't even talk to those investors that are part of that ecosystem. And honestly, it can be a little hard sometimes to know, because not everyone is labeled VC style or not. But the way you can tell is just ask them what they're looking for. If they're looking for, if they use words like scale, high growth, 30x return, exit strategy, these are all terms that indicate that they're looking for a company that's on that path. So the good news is I did some calculations. If you've read my book, you've hopefully seen the calculations I did. Only 0.3% of investors are looking for that. Unfortunately, they do happen to get they suck up a lot of the air in the room. The other 99.7%, you don't really hear from them. They're kind of just living their lives. They're not like on the cover of Forbes or whatever. But they're out there. Those investors who are not on that path are totally out there. In fact, like I said, they make up 99.7% of the investors who are out there. So it's a really bad idea to try to straddle those two worlds. You've got to pick one or the other because they're very different from each other. Those 99.7% of investors who are not what I call professional investors, who are not, haven't bought into that VC model as the best way of investing, they're really happy to let you stay in control. They're really happy to have you pay them a little bit over time instead of looking for that big sale of the company as quickly as possible. They're looking for you to become profitable instead of be high growth at any cost. So anyway, I've noticed in talking to a few people lately that people are trying to keep a foot in both worlds, and it's just a mess. Because what'll happen is I've had clients that have hired me to give them a strategy for raising money, and I've given them a strategy based on, we talked about their business model and their goals and their plans, and I've given them a strategy, and then they've gone and talked to people in the VC ecosystem and got negative feedback. Like, that strategy is really bad. No one's going to invest on those terms. That's really dumb, and I'm like, you're talking to the wrong people, So I just want you to be really conscious of the fact that you do need to choose one or the other, and the longer you try to keep a foot in both worlds, you're really going to make life difficult for yourself. So that's all I wanted to share today. Next time, I think what I want to talk about is choosing between equity and debt. It's becoming coming up a lot with my clients. You can offer either equity or debt to investors, and there's definitely pros and cons to both of them. Some people think debt is only something you would get from a bank or an institutional lender, but you can actually raise debt capital from investors, and you can structure it in all kinds of cool ways, but it's still debt. So sometimes it's not the right choice. Sometimes equity is a better choice. So we're going to talk about, which is better for you, given your particular situation. And in the meantime, if you want to learn a little bit more about the model that I talk about, which is the model that you can use for raising money when you don't want to be part of that VC ecosystem, when you don't want to put your company on that high growth at any cost path, my book talks a lot about that. And if you go to my website, jennykassan.com/raise-capital-book, jennykassan.com/raise-capital-book, you can download some free chapters, and those chapters really do get into kind of that distinction, so you can get a better idea of like what is really the right fit for you, what path do you want to go down. Because the worst thing, and I'm not against you choosing the venture capital path if it's right for you, but what really bothers me is when people inadvertently choose it without even knowing they're choosing it, and then they get on a path that ends up being really the wrong path for them, and all kinds of problems ensue. Either they can't raise capital at all because it's not a good fit, or they raise capital but it's not from the right investors. They have to compromise a lot of things about what's important to them. They may get fired from their own company. So you just really want to choose a side. Don't try to stay in the middle.